Hello everyone. So the stock market is rallying like freaking crazy today. I think every single stock that I own, that's a lie. Every single stock that I own except for one HDB is green on the day, and quite green. So I want to update you guys on what my $1 million portfolio challenge is looking like. This is a portfolio that I built here on the YouTube channel, and I basically wanted to track this portfolio over time to see if I could beat the S&P 500. Now, full disclosure, right away, I have not made any changes to the portfolio yet, although I am thinking about making one change in the portfolio that we are going to get into later on in this video. So with that being said, let's just hop right into it and all of the juicy details about my $1 million portfolio challenge. Right away, yes, my portfolio is beating the S&P 500 from when I started the portfolio, which was around the end of July. My portfolio is up a net of about 1% right now, and the S&P 500 or the SPY ETF is down 2%. A lot of my positions are in the negative though. About a month ago when I did my last portfolio update, I think almost all of my positions were green. That is not the case anymore. And what's funny is my top 4 positions in this portfolio are negative, and they're actually quite negative. I mean, Equitable Bank is down 9% now. Google is down 12.8%. Brookfield Infrastructure is only down 2%, but Alibaba is down 24%. These top 4 stocks have been absolutely not decimated, but they've gone down quite a bit. So let's just start off right at the top with Equitable Bank. This is a smaller cap Canadian bank that's growing double-digit growth rates in Canada. In my opinion, this stock is getting way too cheap. So we're going to head over to Stock Unlock's freeform tool really quickly right here. And I want to show you guys this stock's price to book. So this is a bank stock, right? So usually people look at the price to book and the price to earnings, and that's what we're going to look at in this video. So we're looking at Equitable Bank's price to book all the way out to 2012. And we can see that the average price to book over the past decade has been about 1.08. Well, now this stock is selling for a price to book of only 0.76. So it's selling at a 26% discount to its book value now. And the last time the book value got this low was during the stock market crash of 2020. So outside of the stock market crash of 2020, the book value has not really been this low in the past like 5 years. Now, if we go to the price to earnings for this business, it's now selling for a price to earnings ratio of only 5.3. Its 10-year average has been about 7.4. So it's selling at about a 20 to 30% discount to its 10-year average historical price to earnings ratio. And in my opinion, this is a very, very low price to earnings ratio for a business that's growing its revenue at double-digit growth rates, its book value at double-digit growth rates, and its net income or earnings at double-digit growth rates. It also pays out a near 3% dividend now, and the company's management said that they are projecting to increase the dividend by 25% a year for the next 5 years out to 2027. Which on the share price today will be nearly an 8% dividend yield. And what's also interesting is I have a screenshot right here of the insider buying that has been going on with this business. So right here we can see that just on September 30th, right at the end of the third quarter of the year, Smith Stephen, who is the largest shareholder of the business, he owns about 20% of the company. He purchased another $600,000 worth of shares at $46.28. His company, the Smith Financial Corporation, also purchased about $600,000 worth of shares. And in June and in May, his company bought $3 million worth and $2.6 million worth. So over the past like 3 to 5 months, I'm just going to say, he's purchased about $6 million worth of shares, and he's continuing to buy shares as the share price falls. We can also see that there's a lot of just in general insider buying going on as the stock falls. I mean, this person right here purchased about $240,000 worth of shares, then another $17,000 purchase, and this is all just in September. So insiders are buying a lot of Equitable Bank as the share price falls, and I simply think it's because the stock is now selling at a 26% discount to book and a price to earnings ratio of only 5 while still growing strong. And the management said that they are still on track to meet all their projections for this year. That's my thoughts on Equitable Bank right now. So the next stock here is Google, and I am now down 12.8%. I own a lot of Google shares in my own personal portfolio, and I am down on my position because I've just been dollar cost averaging. And I'm not worried at all because as share prices fall, yields on the stock go up. So I'm going to show you exactly what I mean here. We're going to take a look at Google's free cash flow yield on our freeform tool. And we can see that Google's free cash flow yield, as the share price is going down, the free cash flow yield is absolutely spiking. And the free cash flow yield is now sitting at 5.2%. And if we zoom out all the way to 2012, the last time Google's free cash flow yield got this high was all the way back here in about 2013. So for the past 9 years, in terms of Google's free cash flow, it hasn't been this cheap. It's literally hitting a 9-year low in terms of its price ratio on its free cash flow. If we actually just go to Google's price to free cash flow, this would be a lot simpler. And we can see that right now it's sitting at about 19.1. And the last time it was all the way down here again was in about 2013, at the start of 2013. In 2017, it got down to about 20.9 or about 21, but it's officially cheaper than it was in 2017. And again, you got to go back about 9 years, almost 10 years now, to get Google at this price ratio. So in my opinion, I think that Google is a great stock right now. I am happy to dollar cost average it in my real portfolios, and there's no way that I would ever change this out of my second largest position here in the mock portfolio or the $1 million portfolio challenge. I just think that this is such a solid company, now selling at such an awesome price with so many different tailwinds for growth, and I think it's just an incredible long-term hold. Now, the next stock that I want to talk about is Constellation Software. Now, in my last portfolio update, I said that this was the most expensive stock in my portfolio, and I still hold that belief. And this is the stock that I am considering either selling to buy another one or selling half of it to buy another one. So let me just show you really quickly. If we go to csu.to, this is Constellation Software, and if we go to the company's price to free cash flow, we can see that it's at 25.5 right now, right? This is selling above its 10-year average, and we can see that the stock's price to free cash flow has been expanding over the past decade. The stock that I want to maybe swap out Constellation Software with is Adobe. So check this out. Adobe historically has been selling at a higher price to free cash flow than Constellation Software, but with the recent absolute tanking, I guess, or the crash of Adobe stock, it's lost more than 50% of its value over the past year. Adobe is now selling for a price to free cash flow of only about 17.95, and Constellation Software's price to free cash flow is at 25.5 essentially. So now the premium for Adobe is gone. The market has sold off Adobe to the point where I think there's no more premium, and I think that Adobe has more growth potential long-term than Constellation Software. I also think that Adobe is a little bit of a more solid business. I just like Adobe a little bit more. At an 18 price to free cash flow, I also think that there's more growth potential to Adobe stock price versus Constellation Software. So I haven't made that move in the $1 million challenge yet, but I am strongly considering trimming or selling Constellation Software and swapping it with Adobe. These are both software companies. They're both tech companies. So I think that might be a good switch to do. Lock in that 5% gain that I have on Constellation Software and then buy Adobe with those shares. And I will let you guys know if I do that in the mock portfolio. The rest of the companies here, I don't really want to talk about too much. I think that they're all looking very attractive. Royal Bank of Canada right now, I'm down 3.4% on it in the mock portfolio right now. But I think that this stock is another great buy. In my real portfolio, I am dollar cost averaging this one. And there's just no way that I would sell this. Honestly, I think that all these businesses right here are super strong still. I think the valuations on them are getting super nice. Magnet Forensics, I really like this stock. I've actually bought more of it in my personal portfolio on the dip down to $20 Canadian. Absolute Software is absolutely beating all of my expectations. It's up 40% from when I bought it in this portfolio. In my real portfolio, I'm also up about 50% on it. That one's just been a beast. I don't even know where that came from. Cargojet though. This one right here has been getting hit in the market quite significantly recently. I'm down 16% on it in the mock portfolio now in the $1 million challenge. And this is one that I'm super interested in because I think this stock is actually quite cheap. If we head back over to our freeform tool really quick, let's go and take a look at Cargojet. And the metric that I use on this business is the price to operating cash flow because the business is investing so much in growth right now. And if we zoom into about 2016, we can see that the average price to operating cash flow for this business over the past 6 years has been about 10.3. Right now, the stock is selling for a price to operating cash flow of about 7.2. And take a look because this business's revenue is continuing to grow very, very nicely. It's grown at a 20% compounded annual growth rate over the past 6 years. The business is still growing. The management is holding their outlook for the year of 2022, and they said that the underlying business is fine. However, the stock is continuing to sell off, and now it's selling at about a 30% discount to its 6-year average price to operating cash flow. They also just released an investor presentation like literally a week ago, and they said that they're expecting free cash flow of $320 million to $360 million by 2026 because the company is investing in massive growth right now. They're expanding their fleet, their air fleet, and they're just seeing incredible demand. they're expanding their fleet because they're seeing so much demand, and they have such strong growth potential, in my opinion. So the business is growing strong. It's going to do about $340 million in free cash flow by 2026. And if we go to the market cap of this business today, the market cap is now about $2 billion. So if we go 1920 divided by about $340 million in free cash flow in 2026, this is a forward price to free cash flow of about 5.7, which I think is very cheap given the company's growth potential. Just their execution. Like, this company is absolutely killing the SPY. It's a smaller cap company. Over the past decade, this stock is up 1,176% versus the SPY's 186%. And this is even after the stock is corrected like 50% from its highs. I think the stock is, or I think that the business is incredible at executing. I think they're going to continue executing over the long term. And I think that right now the price is cheap. So there's no way that I would sell this one either. And yeah, that's kind of my thoughts on it right now. But again, in general, I think that all these stocks are very solid. I think all their fundamentals are incredible. And I think this is a very solid portfolio, honestly. I also went over to Stock Unlock and I created this portfolio in Stock Unlock. We haven't released our portfolio tracker yet, but we're working incredibly hard on it. We're working with our beta testers, and thank you to our beta testers because our portfolio tracker is becoming incredible. Now, one thing that we can do in Stock Unlock's portfolio tracker is backtest portfolios. So I entered in all the positions here on the spreadsheet in Stock Unlock, and you can see that the backtest of this portfolio would have grown incredibly well. If we actually compare this to the SPY, over the past 22 years, this portfolio would be up about 5,337% versus the S&P 500's 146%. If we take a look at the past decade, the portfolio would be up about 509% versus the S&P 500's 185%. And let's take a look over the past 5 years. Over the past 5 years, it would be up 108% versus the S&P's 64.5%. So basically, over all historical timeframes, this portfolio is actually outperforming the SPY. Honestly, I only care about what's going to happen in the future because the companies that I invested in the $1 Million Challenge portfolio, in my opinion, are incredibly strong. They have performed very well, and I think that there are businesses that are going to continue performing well in the future. Also here on Stock Unlock, we break down the industry. So we can see that 23% of the portfolio, or about 24%, is in financial services, 15% is in banking, 14% is in media, 13% in technology, 12.5% in retail, and then about 11% in utilities. And then pharmaceuticals is actually cannabis with Green Thumb Industries, but it's labeled a pharmaceutical company still. Now, if we also take a look at the country breakdown right here, we can see that the portfolio is mostly located in Canada and the US. It's like the vast majority is in North America. Then we also have some exposure to India with HDB. I think that India is a massively growing company that's only going to continue growing for decades to come. So I definitely want some exposure to India. And initially, I put about 10% of the portfolio in India in HDB for that exposure to India's growth. Then we also have about 7% exposed to China through Alibaba. Same story with India. I think that China is going to continue growing over the future decades. And I think that Alibaba is like the best company to own in China for exposure to that long-term growth. So that's kind of how the portfolio is structured globally. And that's how the portfolio would have performed over the past 2 decades, past decade, and past 5 years. If we also take a look at the dividend income, the dividend income is 100% in US dollars. So it's doing some currency conversion. But we can see that 54% of the portfolio is in dividend stocks right now. And then 45% of the portfolio is in non-dividend stocks. So 45% is essentially in growth, 54% is in companies that pay dividends. There is no cash in the portfolio. I have this portfolio fully invested, and it's going to remain fully invested in the market, even if I do some buys and sells. We can see the yearly dividends income in terms of US dollars is about $11,000 a year, $900 a month, $30 a day, or $1.26 an hour. Totally passive. So even when I'm sleeping, this portfolio would give me $1.26 US every single hour. Pretty awesome to think about. Now, if we take a look at the dividend payment breakdown over the next year, 34% of my dividend income in this portfolio will come from Brookfield Infrastructure, that utility company that I own in this portfolio. 16% would come from Royal Bank of Canada, 13% from Equitable Bank, 12% from GoEasy, GSY.to, 7.6% from HDB, 7% from BAM, 6% from ABST, 1.6% from Cargojet, and then 1% from other stocks. That's probably Constellation Software. And then over here, you can see your projected income or my projected income, and we can see when the different companies will pay us. So it looks like December will be an awesome month with BIP paying me, BAM paying me, and Equitable Group all paying me. So December, March, June, and September look like very strong months for dividend income with this portfolio. Now, also we can see where I am getting my dividend income from in terms of the different sectors. So I'm getting 34% of my dividend income from the utility sector. That is from BIP. 33% is coming from the financial services industry. 24% is coming from the banking industry. And then only 7% is coming from technologies. So when I take a look at this, it tells me that basically a third of my dividend income is coming from the utility sector, which I do feel good about. Now, I can also see that 1/3 is coming from the financial services sector and then 24% from banking. So that's about 56% of my dividend income coming from like the financials sector. Personally, I am okay with that, but I know a lot of other people commented on my last portfolio update saying that this was a large portion of the portfolio exposed to financials. Now we can also see where the countries or where the dividend income is coming from in terms of geographically. 58% of the dividend income is coming from Canada, 34% is coming from Bermuda, and then 7.63% is coming from India. So I'm actually not really getting any dividend income from the United States. A lot of the growth in this portfolio is based in the United States, and then the dividend, a lot of it is based in Canada, and then 34% of it comes from Bermuda because of BIP. But yeah, that's kind of the portfolio right now. That's how it's performing. That's how it would have performed in the past. That's where all the dividend income is coming from. And I just kind of wanted to make this video to update you guys with my $1 million portfolio challenge, how it's performing, what my thoughts are on these stocks, and potential moves that I might make. Again, the one potential move that I might make is trimming or cutting Constellation Software for Adobe, because I think Adobe is just much more valuable right now. So that's the portfolio. I just wanted to do a quick update for you guys. If you enjoyed the video, please remember to leave a like on it. The market is being crazy today. I might make a video tomorrow on what's going on with the market and the volatility right now. But yeah, if you enjoyed the video, again, please remember to leave a like on it. Thank you guys so much for watching. As always, I truly do appreciate it, and I really hope to see you all again in my next video.